These lessons could change your future. Just one small click. Subscribe and grow with us. You're watching, learning, feeling. Will you stay with us? Just one click to subscribe means everything.
Great portfolios are not built in a day. It takes years to create a portfolio that can stand the test of time and deliver great returns. But do you have the patience and time? We live in an age of instant gratification, where everything should be delivered at the click of a button. Not surprisingly, we even demand portfolios that can make us millionaires in a fraction of a second. But sadly, the stock markets don't work that way. All good things come here to those who wait. In this book, you will understand the mechanics of long-term investing and also get a closer look at the common mistakes made by investors. The name coffee can portfolio has roots in the American Wild West, where people used to keep their savings in coffee cans before banks became widespread. But the concept was rediscovered by a new age American banker who made a startling discovery in his client's portfolio. It is an interesting story where he advised one of his clients to mirror the portfolio the banker created. The only difference was that he kept churning his portfolio while his clients didn't sell a single stock. After a few years, the value of the client's portfolio was substantially higher than his own portfolio. This helped him to appreciate the value of long-term investing and the effects of compounding. It also prompted him to name such a portfolio with a long-term horizon as Coffee Can Portfolio. Although the book has an American name, its contents are based on the Indian scenario. The book starts with these interesting stories about how Indians build and manage their portfolios. Then it talks about the irresistible charm of real estate for Indians and discusses the pros and cons of it. In the next section, the book looks at some of mid-cap stocks in the Indian markets that have the potential to find a place in a coffee can portfolio. The last section of the book will give you tips to create a suitable portfolio. Coffee can investing challenges the conventional wisdom of frequent portfolio churn and instead emphasizes the benefits of stability and compounding. The author's extensive research and real-world examples bolster their arguments, illustrating how this method has yielded substantial returns for patient investors. Coffee can investing offers invaluable insights into a unique investment philosophy. By delving into coffee can investing, you'll glean not only a unique investment strategy, but also a broader perspective on wealth creation. The book encourages readers to resist market noise, hone their analytical skills, and develop the discipline required for long-term success. Whether you are a seasoned investor or just stepping into the financial realm, this book offers a refreshing and enlightening perspective on wealth generation through patient investing. It's time to plug in your headphones and listen to Coffee Can Investing by Saurabh Mukherjea, Rakshit Ranjan and Pranab Uniyal. The first chapter starts with an imaginary case study. It gives us a vivid picture of the typical Indian middle-class household and their ambition. The constant sacrifices that families have to make to fuel their dreams of education, marriage, and an own home that lie in a distant future. The author explained that most Indian families shy away from investing money in stocks and instead prefer the traditional investment avenues like fixed deposits, gold, and real estate. The author goes on to explain that these investments can actually erode investment, as they tend to have even lower returns than inflation. For most investors, the path to financial freedom is generally dotted with safe investments as mentioned above. Although there is nothing wrong with investing in these avenues, in fact, these investments should be an integral part of a balanced portfolio, but they should not form the bulk of the portfolio. Researchers have shown that over the long term, equity tends to outperform all other forms of investments. The chapter explains the reluctance of middle-class families to invest in equities And the most common reason for this is the lack of good advice. The author explains that most financial advisors are driven by their own commissions and fail to put the customer's interests before theirs. Unfortunately, most people are too busy to monitor their portfolio on a regular basis, and their money just sits there doing nothing. The chapter also talks about the 7 basic investment mistakes that most Indian investors make. Let's have a glance at the most common mistakes. The first mistake is the lack of a clear objective or a goal. It is a common trait as most investors put their money where the rumor is. They are not clear about where they want to be in the next 10 or 15 years, and so their investment plans are not clear. The second is the tendency of trading too much at a regular pace. Investors rob themselves of the benefits of compounding and long-term investing by buying and selling stocks at quick intervals. Indian investors also make the mistake of putting all their eggs in the same basket. They do not diversify their portfolio. This increases the risk associated with investment. Most of the investment is done in gold or real estate. High commissions and fees are the silent killers of any portfolio as they compound with time too. Most Indian investors don't look closely at the fee structure of investment products and happily pay commission to their advisors. This is counterintuitive and affects the performance of the portfolio in the long run significantly. Indian investors are generally interested in a quick buck for their money, and hence they go around chasing quick returns. They forget to take into account the risk associated with an investment. Another favorite indulgence of Indian investors is the attempt to time the market. Most investors believe that they are smarter than others and can enter at the bottom of the cycle and leave at the top. But this overconfidence generally leads to losses as markets behave in a very unpredictable manner. In the first chapter, we heard about the reason for poor portfolio performance. Now let's get straight into fixing the issue. The second chapter dives straight into the solution. The author states that it is important to frame the investment problem in a clear manner. Even people with exceptional IQ can make very poor investment decisions. There is an interesting story about the great investor Isaac Newton, who invested a hefty sum in the South Sea Company, the hottest stock in England in 1720. Unfortunately, he lost all his money in the stock and thought to himself that it is easier for him to predict the motions of heavenly bodies than the madness of people. Newton's experience proves that it is easy for even intelligent people to fall prey to the madness of crowd. This is the story of most investors even today in India. Most people struggle to answer two simple but important investing questions: which stocks to buy and for how long to hold the stock. But this is not an easy question to answer, as most investors are fed false information by substandard investors. Another misconception is the risk-reward trade-off. Investors are cajoled into thinking that to achieve higher returns, it is important to take more risks. It is for these reasons that investors tend to become punters in the long run. They end up buying stocks based on unsolicited tips from friends and family. No wonder they lose money in the long run and are taken for a walk by their stockbrokers who make a hefty commission at their expense. Benjamin Franklin said, "An investment in knowledge pays the best interest." The author takes inspiration from this quote and says that we should learn from investors who have methodically practiced to stay patient and make money in the long run. The first thing to learn from great investors is to look for companies that have a moat or a distinct competitive advantage. The importance of investing in companies with moat is emphasized in this quote from Akash Prakash, founder and CEO of Amansa Capital, a Singapore-based foreign institutional investor. He says, "Our view has always been that we need to invest in companies where we can trust in the people who are running the company. Trust, in turn, is driven by capital allocation. Where you get shafted by entrepreneurs other than through theft and bad accounting by crooks is capital allocation. In an environment like India, where you have so many perceived good opportunities, if you invest in poor capital allocators, you will never get a return. Secondly, our firm belief is that good management teams create optionality for you. In an environment like India, smart managers can create a lot of wealth. Therefore, even more important than the buy decision is how long can you let that position run. At Morgan Stanley, at its peak, we own 14% of Infosys. What's creditworthy is that we held on to it for so long. Unless a stock reaches an absurd valuation, or if something fundamental has changed in the business environment for that company, or something critical has changed in the company's growth outlook, we prefer not to sell stocks that we own. Our view is that there are a limited number of companies in India where everything lines up. Good business, capable and ethical management, you have access to the management. Such combinations do not come that often. Based on the investment advice of such legendary investors, the authors of the book decided to create a portfolio of high-quality companies with a time horizon that ran into years. This was the first step in creating the coffee can portfolio. Robert Kirby is credited with the creation of Coffee Can Portfolio. He was working as an investment manager in Capital Guardian Trust, where he managed the portfolios of wealthy individuals. The story goes that Kirby made an interesting discovery in one of his clients' account. As narrated earlier in the audiobook, to recount, his client bought all the stocks Kirby suggested but didn't sell anything. This approach of buy and forget led to enormous wealth creation for the client and inspired Kirby to coin the term Coffee Can Portfolio. The concept of not intervening in a portfolio, even in a downward spiral, may be a difficult pill to swallow for the average investor. But this idea is profound and can be the difference between a winning and losing portfolio. Kirby's Coffee Can Portfolio became popular in the US, and 5 years ago, Ambit recreated the Coffee Can Portfolio for Indian investors. The Coffee Can Portfolio for the Indian investors have been tweaked to suit the Indian markets and investor preferences. The portfolio was constructed using filters to identify 10 to 25 high-quality stocks and then left untouched for a decade. The portfolio outperformed the benchmark indices by an impressive margin, both in backtesting and live portfolios. Rigor is the secret recipe for creating a coffee can portfolio. To make it more relevant for the Indian markets, only companies with a market capitalization of 100 crores or more are chosen. This means that not only about 1,500 companies out of 5,000 listed companies in India made the initial cut. Next step is to look for companies that have grown sales by at least 10% over the last decade and generated pre-tax return on capital employed (ROCE) of at least 15%. Before we delve further, let's understand the concept of ROCE, as it is an important measure of a company's financial performance. In theory, ROCE is the ratio of EBIT, earning before interest and tax, and capital employed, sum of debt liabilities and shareholders' equity. In simple terms, ROCE measure how efficiently the company is able to deploy its capital. A higher ROCE shows that a company is able to deploy its capital efficiently. In the book, a minimum ROCE of 15% is used, as the authors believe that this is the bare minimum required to beat the cost of capital. For financial companies, the authors have used the return on equity (ROE) matrix, as it indicates a bank's ability to generate higher returns efficiently on a given capital base. When the data was backtested, with the proper filters in place, it was shown that the coffee can portfolio has a 95% chance of generating positive return if held for a period of at least 3 years or more. And if held for 5 years or more, the portfolio can generate even a return of 9%. The next obvious question is, why does the coffee can portfolio perform so well? Is it the choice of stocks that makes the difference? Or is it the long duration of holding the stocks that generates higher returns? To explain this, the book gives an interesting analogy about the great Roman Empire. It was the most formidable empire ever to rule the world and lasted for a staggering 1400 years. As a matter of fact, the concept of compounding that forms the basis of this book also comes from the Roman Empire. In a similar vein, the coffee can portfolio looks for great companies that can withstand adverse situations and maintain superior financial performance. The twin filters of coffee can portfolio are like the twin engines of a car. Great companies are not built overnight, and neither do they deteriorate in a quarter. They have the wherewithal to sustain their competitive advantage over a period of 10 to 20 years. They might look calm at the surface, but there is a lot of action going on below. This keeps them nimble-footed and ahead of their competitors. These traits are rare and generally found only in great companies. The next obvious question that pops up is, why should we use ROCE as a measure of financial greatness? Charlie Munger, Vice Chairman of Berkshire Hathaway, explains it in a succinct manner. He is quoted in the book as, "Over the long term, it's hard for a stock to earn a much better return than the business which underlying it earns." To put it simply, the returns earned by a stock over the long-term run is generally the same as the return on capital employed by the company in its day-to-day business. He explains it further with this simple example. If the business earns 6% on capital over 40 years and you hold it for those 40 years, you're not going to make much different than a 6% return even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital every 20 or 30 years, even if you pay an expensive looking price, you'll end up with an impressive looking result. After a fair understanding of the importance of ROCE, it is time to look at an Indian company that can pass the test of greatness. The company in question is Page Industries, the company that controls the master franchise of Jockey and Speedo in India. In the last 15 years, the company has achieved revenue growth of more than 10% and ROCE in excess of 15% each year. Page Industries is the perfect example of a company that requires capital to grow and generates decent ROCE. Although the company has consistently reinvested its profit into expanding its manufacturing capacity, has still managed to generate healthy ROCE on reinvested capital as well. The impressive growth in CAGR is reflected in the company's share price too. The company's stock price has compounded at an average rate of 45% per annum over the past decade. This is commendable performance considering the fact that Page Industries has operated with a single brand in India and thrived in the face of competition from well-established domestic brands like VIP and even international giants like Heinz. The success of Page Industries is a result of its constant effort to maintain its moat. The company has maintained strict discipline in allocating capital. Page Industries takes its capital decisions based on growth and expansion. This includes understanding subjects like market expansion, penetration, and leveraging new technologies to reduce production costs. Let us understand a little about the three main reasons that have helped Page Industries to maintain its moat. Manufacturing prowess is Page's biggest strength. Innerwear is a highly labor-intensive industry. Unionization is a common industry-wide problem and leads to substantial production loss. Page fixed these issues by ensuring only a fixed number of laborers at every plant. The company focused on hiring women who are less susceptible to unionization than men. The company also ensured proper lifestyle support for workers to reduce attrition. Page Industries has also done very interesting work at the customer front too. Customers like to stick to a particular brand or style once they get used to it. The company has maintained the consistency and quality of its products across different geographies. Finally, the company maintains freshness of the products by introducing new colors and designs at regular intervals. This is an amazing feat for an innerwear company in India. After the fascinating case study, it's time to bring our attention back to the coffee can portfolio. An underlying reason for the success of portfolio is that it is not churned, and for good reasons too. In the short run, equities are prone to extreme movements. But as the time period increases, equities have always given impressive returns. Secondly, a longer time horizon is important to allow the power of compounding to set in. Over the long term, winning stocks overshadow the performance of the losing stocks and deliver handsome returns. Holding the stocks for longer periods of time also saves the transaction costs. Finally, a longer time horizon acts as a shield against the constant market noise that may drive emotional decisions. In the next chapter, the authors take on the sensitive but often overlooked topic of expenses. It is not surprising that most investors don't pay attention to the charges levied by mutual funds or brokerage houses, as they are often a very minute percentage. But compounded over a long term, these charges can dent the fund value. For instance, if you invest 1 lakh for 40 years and assume a growth rate of 15% per annum, the final value will be 1.11 crores if the expenses expense is 2.5%. But the same figure will be a whopping 2.58 crores if the expense is 0.1%. Investors, especially in the US, have started realizing the impact of these costs on their investments and have started to shift to passive mutual funds instead of active funds. In India, Securities and Exchange Board of India, SEBI or SEBI, is also taking initiatives to encourage investors to purchase mutual funds by paying off a certain percentage as advisory and investing in the most inexpensive fund rather than using an intermediary who is rewarded for churning the portfolio frequently. Real estate has always been an irresistible charm for Indians, and it enjoys the maximum share of portfolio. Indians have always associated real estate with safety, status, and prestige. Although real estate had its heydays, but now it has just become a thorn in the side of most investors. In this chapter, we get a picture of the evolution of real estate landscape in India. The book states that until the mid-1990s, only affluent families in India owned a house. Most people were employed by the government or private sector companies and stayed in government quarters. But in the next decade, the interest rates came down dramatically. This made home loans cheap. The disposable income of the middle class also went up, and there were many tax incentives offered by the government for buying a house. All these factors led to a household boom and a growing interest in buying homes. It is not uncommon for friends and relatives in India to offer real estate advice, but as a smart investor, you should be cautious and look out before diving into a real estate deal. There are a few reasons that make investment in real estate a risky affair. Let us look at a few of them. The first is the investment size. You can enter the stock markets with as little as 500 or 1000 rupees, but you will need at least a few lakhs to invest in a property. This makes real estate a rich man asset class and prevents the widespread adoption. The second reason is the illiquid nature of property. You can buy and sell stocks at the click of a button, but you may have to wait for years to find a buyer for a property. Next is the transaction cost associated with buying the property. There are various costs like stamp duty, registrations, and so on, which now exceed 10% of the cost of property. The fourth reason is the non-standards nature of real estate. Properties behave in a different manner. While a piece of gold would fetch you the same price anywhere in the world, property prices vary even in the same neighborhood. This makes real estate unpredictable, and success depends as much on luck as on a well-thought strategy. Finally, real estate is not a very well-regulated sector in India. There are many regulatory hurdles due to which it is easier for the big fish to make money here, while the middle-class investors only sit at the fence and watch the show. In spite of all these drawbacks, Indian investors still flock towards real estate. Land or property is hard-coded in our minds as safe and reliable investment option. According to a report by RBI, only 5% of India's household savings is invested in financial assets compared to 77% in real estate. This lopsided preference for real estate explains why Indians love to invest in real estate. Investors also believe that real estate prices only go up in the long term. A lack of real estate price indices fuels this belief and gives a false hope to investors. But a few recent reports have clearly shown that there have been major price corrections in the real estate sector. In fact, just like equity and debt, real estate is also prone to cyclical ups and downs. Real estate investors have also myopic vision of the absolute returns. On a compounding basis, real estate sector has earned only 8.3% over the last 20 years, although the property has grown 5 times. In the same period, India's stock market benchmark index has risen by 15%, which is almost 16 times return. Such an objective calculation is important to evaluate real estate in a proper light. You don't have to necessarily buy a house to invest in real estate. Fortunately, there are many options available today that can help you to participate in a real estate sector. The first one is a real estate private equity fund. It gives funds to developers in exchange of equity. The investor's return depends on the time it takes to complete the project. Real estate private equity funds have enjoyed limited success due to project delays and government approvals. The next option is the rental yield funds. These funds invest in ready properties and not projects under development. The fund's objective is to invest in commercial property and earn the high yields. These funds have fared better than the private equity funds. Along with these two options, some other avenues of investing in real estate include non-convertible debentures and REITs, real estate investment trusts. You can read in more details about them in the book. From the brick and mortar world of real estate, let's turn our attention back to the stock markets. In this chapter, the authors discuss about one of the favorite debates in the stock market, large cap or small cap stocks. Across the world, small cap stocks have outperformed the large cap stocks in most stock markets. The trend is similar in India too. But why do small cap companies constantly outperform the bigger counterparts? According to the authors, there are 2 reasons for this. First, smaller companies can grow their profits faster than larger companies. And second, the smaller companies are discovered by the stock markets as they grow. Let's look at the first point closely. Smaller companies have a hunger to grow that drives to perform at the highest level. Somehow, this hunger is missing in larger companies. Most industry leaders in a sector in India tend to become industry laggards in a short period of 5 years. On the other hand, smaller companies don't have to go through layers of management hierarchies to take a decision. This keeps them nimble and helps them to respond quickly to the changes in market conditions. Now coming to the second point of the stock market discovery. Small cap companies generally suffer from neglect as they don't get enough attention from brokerage houses. As a result, these companies are generally brought to the forefront only after rigorous research. It is true that small cap companies offer a wealth of opportunities for investors, but it is important to note that they are fraught with more risks as compared to the large cap stocks. A fundamental reason for this is that smaller companies often lose track in trying to become big. A classic example of this is the collapse of India's first low-cost carrier, Air Deccan. The company suffered huge losses and had to be eventually sold off to Kingfisher Airlines. Here's a quote from Captain Gopinath, the founder of Air Deccan, where he shares his thought. He says, "Given a little more time, Deccan could have weathered the storm and overcome the cash crunch, but time was running out. I might have pulled it off had my IT systems not collapsed." We had to bear in mind the welfare of 4,000 employees, the public insurance funds, and retail investors we had to answer to. There are other interesting case studies of companies like TTK and Eicher Motors mentioned in the book that give a glimpse of how difficult it can be for smaller companies to run a successful business. These case studies will help you to understand the strategies that help smaller companies to compete with giants and decrease their relevance on a single product, which is generally the weak point for most small companies. From the dynamics of small caps and large caps, it is now time to understand the psychology of investors. It is rather unfortunate that in spite of delivering compounded annual return of 13.7%, most Indians are wary of putting their money in the stock market. The common perception in India is that more often than not, people lose money in the stock market. This behavior can be explained as myopic loss aversion, a term coined by Sholmo Bernatzi and Richard Thaler. They say that people regret losses 2.5 times more than similar sized gains. As an example, let us assume that a person buys two stocks A and B for ₹100 each and sells them for ₹95 and ₹110 respectively. The person loses ₹5 on stock A and gains ₹10 on B. Our total gain is ₹5. According to myopic loss aversion, the person will regret the ₹5 loss more than he or she will relish the ₹10 gain. For this person, the probability of making profits should be twice as much as that of making a loss. A deeper research shows that people who don't even have a year of patience are more likely to lose money. Also, people who have short or myopic time horizons are more likely to witness a loss in their portfolios. The second point that the chapter illustrates is that the quality of stocks play a bigger role in returns in a shorter period, say 3 to 5 years, as compared to longer time periods, say 7 to 10 years. An investor who can combine patience with high-quality stocks will drastically improve his chances of generating a profit in the long term. As we move towards the fag end of the book, it's time to distill the most important points that will make you a better investor. The first is, of course, the urgent need for a financial plan. Most people just keep shooting in the dark and daydreaming when it comes to their financial goals. Having a plan will help you quantify your goals. More importantly, it will help you understand your risk appetite and build a portfolio customized for your purpose. The second aspect is that of expenses, which are often overlooked. Expenses compound at a ferocious rate and can nibble away your profits. You should choose investment products that have the least charge structure. Finally, you should appreciate the power of patience and invest only in high-quality investment products. Patience is in short supply in the financial markets. People are in a hurry to get rich and more receptive to ideas that promise quick gains. Even financial agents are rewarded for selling products with the highest commissions, without keeping the interests of investors in mind. In such a scenario, you should safeguard your interests and ensure that your advisor is qualified and well-versed with the dynamics of the market. In the last chapter, the book will help you to create your own financial plan. It should be noted that you need a sound financial planner to create a plan. But the inputs in the book will help you to understand the process and condense your financial data. It is an interesting exercise and one of the best takeaways from the book. This brings us to the end of this audio recording. To sum it up, I really enjoyed reading this book, and I believe this book will help you to develop your financial acumen too. It is a great effort by the authors to write a book relevant to the Indian markets. The book takes on an international investing concept and customizes it perfectly for the Indian stock markets. I believe the book will change your perception about the Indian stock markets and help you to become more patient and grounded. You will also learn the value of investing in quality stocks. It is a great investment into your future and perhaps holds the key to your fortunes. Key takeaways. A few key takeaways from the books are: it is advisable to enter the markets only with a sound financial plan. Stocks should be an integral part of your portfolio along with debt instruments. Real estate can be an investment trap and should be handled carefully. A portfolio of small cap stocks left untouched over a long period of time can generate phenomenal returns. A little about the authors. Saurabh Mukherjea is the CEO of Ambit Capital, an Indian investment bank. He's a London School of Economics alumnus and is a CFA charter holder. He is a leading author and has written many successful books on investing, including The Unusual Billionaires. Rakshit Ranjan is the portfolio manager of Coffee Can PMS. He has been ranked amongst the top 3 research analysts in his sector, both in the UK 2007 to 2009 and in India 2015 and 2016. He is a CFA charter holder and a BTech in chemical engineering from the Indian Institute of Technology, Delhi. Pranab Uniyal is the head of products and advisory at Ambit Capital. He has a BTech in chemical engineering from Indian Institute of Technology, Madras, and a postgraduate diploma in management from Indian Institute of Management, Calcutta. You are listening to the summary of Coffee Can Investing by Saurabh Mukherjea, Rakshit Ranjan, and Pranab Uniyal.
These lessons could change your future. Just one small click. Subscribe and grow with us. You're watching, learning, feeling. Will you stay with us? Just one click to subscribe means everything.
If your journey feels stuck, you're not alone. We've got you. If you found value in this video, don't forget to hit that like button. It helps more curious minds discover this content. Subscribe to Being and Beyond and join a growing community that thrives on knowledge, perspective, and personal growth. And if this video resonated with you, share it with someone who needs to hear it today. Your support fuels our passion and pushes us to create better content. Welcome to Being and Beyond.